Hi, I'm Pattu from freefincal. Let's take a look at the UTI S&P BSE Low Volatility Index Fund. This is the second new fund offer that I have invested in after the Parak Parik Flexi Cap Fund. In hindsight, the Parak Parik Fund turned out to be alright. I don't know how this is going to turn out. Let's discuss the pros and cons of the fund. I have been talking about low volatility indices and low volatility stocks for several years now, since 2016 at least. And freefincal publishes a monthly stock screener based on momentum and low volatility that you can access from here. And I also publish my direct equity portfolio, the performance of the portfolio once a month and so on. So ICICI has a nifty low volatility 30 ETF and a fund of fund, but I have always been against investing in ETFs, at least Indian ETFs, and therefore any fund of fund based on ETFs. So I have not recommended that, and I have not invested in that. But I have previously maintained that if there is an index fund based on low volatility, then I'll be interested, and such an offer is now available. So the BSE Low Volatility Index is 30 stocks from the BSE Large Mid Cap universe. There is a stock weight cap of 5%. There's also a stock weight cap in the Nifty 100 Low Volatility 30 Index, but that is from the large cap universe. This the BSE Low Volatility Index will be from the large and mid cap universe, but there's not much of a difference between the two. So if you look at the growth of the two low volatility indices for the last 10 years, the BSE index has a slight edge. That's the top line, but that's not much of an edge, because if you look at the returns over 5 years, the 5-year rolling returns, there's not really much of a difference. The yellow line is the Nifty 100, that's got a longer history. The orange line is the brownish orange line is the BSE Low Volatility Index. There's not really much of a difference between the two indices. Now, if you look at the since inception, or I should say the last 10 years, since inception is not available at the BSE. So since the last 10 years, the low volatility index has comfortably bet the BSE and the BSE large mid cap. And also, if you look at the 5-year rolling returns, the white line is the low volatility index, the blue line is the large mid cap index. Generally, the low volatility index has outperformed the large mid cap, except for over the last few months where the performance has been more or less similar. So this is important, because if you invest in this low volatility index expecting higher absolute returns, then you may not get it at all times, because the expense ratio of this UTI fund is expected to be anywhere between 2 to 4 times more than their Nifty index fund. So the expense ratio will play a role in determining the returns. So don't expect higher absolute returns at all times. Now this is the Nifty 100 Low Volatility 30 with respect to Nifty 100 that has got a much longer history, and you can see the outperformance margin over the years has come down. It may go up again, it may not go up again, we don't know that, but we cannot expect the low volatility index to provide an absolute return at all times. So this underperformance that you see for the first time essentially could mean that the market dynamics has changed since the backtest conducted by BSE or the Nifty 100. That's just what we have been saying in several videos. No strategy will work at all times. So we have to be careful with that. So if you look at the 5-year rolling standard deviation of all the indices, you can see that the lowest is the brown line is the BSE Low Volatility Index. The yellow line on top is the Nifty Low Volatility Index, and above that you can see there's a gap, and then you see the Sensex large cap, BSE large cap, and so on. So when you buy a low volatility index, you are guaranteed of low volatility. It may sound trivial, but that it's important to understand that. What does this mean? So low volatility basically means you get a lower standard deviation than the base index. That means that the NAV fluctuations or the index fluctuations will be lower in the low volatility index compared to the base index. This means that even though you may not always get a higher absolute return, the low volatility index is likely to provide you a higher risk adjusted return. Risk adjusted return means return generated per unit risk taken. So that's basically something, approximately the formula will be like return divided by standard deviation. Since the standard deviation is low for the low volatility index, the risk adjusted return will be higher in the case of the low volatility index fund also. But the expense ratio will play a role in this as well. The tracking error will also play a role. So a good fund, when you package it in the form of a ETF or a fund of fund or an index fund, that can be a bad product. So we don't know that. So the reasonable expectation one can have is, even if you don't get higher absolute return with the low volatility index, you have a reasonable chance of getting a higher risk adjusted return, that is return generated per unit risk taken. That's a reasonable expectation, but expense ratio, tracking error will play a role. If you contrast this with the momentum offering, UTI has a momentum offering as well. In the momentum case, you are chasing higher risk. In the low volatility case, you are chasing lower risk. If you chase higher risk and don't get higher return, you end up with lower absolute return and lower risk adjusted return. If you chase low volatility and don't get higher absolute return, at the very least you are likely to get a higher risk adjusted return. So that is the thought process with which I have invested in this fund. For me, the journey matters. When we talk about returns in anything, when it's capital market linked, returns are always in hindsight. Only when you go from A to point B, you sit at point B and you look back, then you look at the returns. So you calculate the returns in hindsight, whereas the journey is where the risk is. How you go from A to B matters. Was it a high risk path or a low risk path? I prefer to take the low risk path, and therefore I have an interest in this fund. You must decide what is good for you. I cannot judge that. For my age and my portfolio and my circumstances, I have always been looking at a alternative for quantum long-term equity. For me, quantum long-term equity, I liked its low volatility. Obviously, it's not been performing well. Everybody knows that. I've been looking at an alternative. So for now, I made a fresh investment in the UTI low volatility fund. That will be my fourth fund for retirement. Parak Parik has got the highest concentration. I was trying to reduce it, but thankfully the stoppage of subscriptions has made it easier for me. So Parak Parik Quantum is the third lowest. The second is the HDFC balanced fund or HDFC hybrid equity. This will be the fourth fund. For now, I'll gradually rebalance out quantum and to debt with in future and so on. Now coming back to this idea of risk adjusted return, if you compare the S&P low volatility index in the case of US stocks with the S&P 500, I have done this before. The link is available. You can go to the community page and get it. If you look at the absolute return, it will not be different. But since the volatility of the low volatility index is obviously lower, even in the case of US, there is a reasonable chance that the low volatility stock investing gets a better risk adjusted return instead of higher, absolute return. Absolute return doesn't happen in the US case. In India, even if it disappears, at least you are left with a better risk adjusted return. Only some people appreciate it. Many people don't appreciate it. Well, if they don't appreciate it, they're never going to understand what I'm trying to say. Right now, but standard deviation is only one type of risk. What about drawdown? That is the fall from a peak. Now, this is the drawdown for the Nifty low volatility 30 index, that's the black line, and the Nifty 100, which is the orange line. You can see that the black line fall typically has been lower than the orange line fall. In just one instance here, the black line fell a little bit more than the orange line, but typically you expect a lower drawdown. So the thinking is, when you choose low volatility stocks, the journey will be smoother. The drawdown, there's a reasonable chance for the drawdown, that is a fall, to be lower. And also generally, when you have a stock which is stable in price, that means the company also is stable. There is no something seriously wrong with the company. There's no sudden positive news or there's no sudden bad news. So in that way, it's a solid company. That is the thinking behind low volatility indexing. It may not always work. Now, Siva from Asan Ideas of Wealth have shown that low volatility indexing does not work when the interest rates are high, and vice versa. But such kind of a correlation has not been found in India so far. But our history is very short, so we don't know. We are still evolving. It can so happen that after 5 years I find that my absolute return after expenses in the low volatility fund is lower than a 5-year return from Nifty fund or Sensex fund and so on. That's possible. I mean, that can happen. So this call of mine can fail. So don't take what I'm doing seriously. I am doing what is suitable for me. I mean, you should do what is suitable for you. Also, I have the my portfolio as a time series. That is my portfolio value versus date. Every day I have that. I don't have it literally every day. I can generate it whenever I want. I can use that to evaluate the diversification in my portfolio, evaluate the volatility and the drawdown in my portfolio. Many people may not have such facilities. They may not know the impact of having a low volatility fund in the portfolio. That is what I'm trying to say, or any other fund for that matter. There is an opening in my portfolio. I have filled it with this fund. I don't know whether you have an opening. That is something only you can judge. So that's what I've done, and you must appreciate that this idea of low volatility indexing may not work out in the future. So I'm willing to take that chance. I am in a position where I can take that chance. I don't know whether you can, whether you have. Market experience teaches you that anyway everything is a chance. So that's about it. So if you have any questions, please let me know.